Hi and welcome to my Screencast video. Today I'll be talking about adjusted journal entries. Adjusted journal entries are entries made in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. Now that we've covered this, it's time to look at two of the four main scenarios in which adjusting entries are required and the necessary adjustments needed. Today I'll be focusing on two of these four, with deferred expenses and deferred revenues in my viewpoint. The first is deferred revenue. This is when a company receives cash before it provides a service. The term deferred is used since at the time of the cash receipt, a company has not yet provided the promised service and thus cannot record revenue. Instead, the company must record a liability. A general rule for deferred revenue is when a company is recording the adjustment, it should always increase a liability account for the amount received. As the company provides the service, the liability is adjusted down and the related revenue is adjusted up. Here is an example of deferred revenue, where on the 31st of May, Circle Firms filled the retirement reception for a customer who'd paid $2,000 on May 10th. Here you can see unearned revenue is debited for $2,000 and service revenue is credited for $2,000. Therefore, assets and liabilities equal zero to show the adjusted entry. Secondly, I'll be talking about deferred expenses. This is when a company pays for a resource before it uses or consumes it, and so has a deferred expense. The term deferred is used since at the time of the cash payment for the resource, the company has yet to use the acquired resource and therefore cannot record it as an expense. Because of this, we record the unused resource as an asset. When recording the adjustments for deferred expenses, the company should always increase asset account for the amount paid for the resource. As the company uses the asset, the account is adjusted down and the related expense is adjusted up. Depending on the type of asset, either the actual asset account will be decreased or a related contra asset account, like accumulated depreciation, will be increased. Here you can see an example of deferred expense. After a physical count, Circle Firms determines that it had $650 of supplies remaining. Here you can see the asset account, or supplies, is decreased down by $350, and the related expense account is adjusted up by $350. Therefore, assets, liabilities, and equity equal zero.